Hey everybody, Rob Kientz with 𝙂𝙊𝙇𝙑𝙀𝙍. I'm recording this on December 12th, 2022. This is going to be a weekly market wrap up. We generally put this on the channel Sunday afternoon as the precious metals markets begin to open and people start doing their planning for the week. In this case, it's going to be a little bit late. We're putting it out on Tuesday, the December 13th, instead of the live stream because I just spent the weekend in the hospital with my daughter. She's 19 years old. And she just developed type 1 diabetes. And she was so high on her insulin, they wouldn't let her, so high on her blood sugar, they wouldn't let her leave. Type 1 diabetes really is, it's an autoimmune deficiency caused by a lot of things. It could be genetic, it could be environmental, but it's not just diet. So it's not, though she put herself in this position. In fact, she had pretty much wasted away to about 89 pounds and her body was eating her muscle. There was no more fat left on there. She has basically no fat in her body to speak of. So in any case, diet's a part of it, but she's insulin dependent. She has to take it. And the unfortunate circumstance of that was it manifested on Friday with her going to the emergency room and calling me and saying, Dad, I'm going to the emergency room. I don't feel well. And, thankfully we got it under control. We had spent most of the day Sunday trying to get insulin. Apparently there's a local shortage, which is not great. But we're getting that under control. She's out of the emergency room and she's doing well. And when we're getting her over to an endocrinologist who's going to be her primary care for the next 10 to 20 years as she deals with this. So in that case, I'm not doing a Tuesday Night Live. I apologize to you guys. I just have to focus on family this week. It's hard. So much going on. But thank you guys for your support, and I hope you enjoy this episode and Thursday night. I'm going to try to come back and do the live. Thank you.
Welcome to Gold Silver Pros.
Everybody, this is Rob Kientz with 𝙂𝙊𝙇𝙀𝙍.com, and this is the weekly market wrap. I'm recording this on December 9th, 2022, about 9 in the morning, as the markets have just gotten opened up, and there's a lot to talk about here. Gold price at the moment is trading at 1793.57. It's up $4.33 on the day. Silver is trading at $23.18, up about 8 cents on the day. Silver has broken through critical resistance at 22 or 22.50, depending on which technical pattern you're trading. And it's been that way most of the week. So it's a good sign to see silver sitting at above 23, and looks like it may end the week there. We'll have to see what goes on the rest of today, but definitely bullish breakout sign for silver. And we'll watch it at the end of the year and see what happens. In gold, 1793, we had eclipsed a critical $1,800 support line with gold, but the good thing is we're staying near that $1,800 line, which is good. Gold really hasn't stayed above its 50 and 200-day moving averages for any length of time, so we'll have to see what goes on in gold, but it's very positive for the metals that they're both up this week. The rest of the markets are basically down today. As I'm reading the markets, the Dow Jones Industrial Average is down 100 points, or 0.3%. The S&P 500 is down 7 points, or 0.2%. NASDAQ is down 23 points, which is 0.2%. And the Russell down 3 points, down 0.2%. You'll notice all the markets seem to move in tandem. And I believe that's because most of them are traded through algorithms and computer software and collective thought or groupthink by the market. But sometimes they'll break away and do different things, and we'll cover that on the program when we get there. Getting into the cryptocurrencies, Bitcoin's going to end the week up if the trend persists. It's 17,159.68 now, down $47 on early trading. Ethereum is down $5.74 to 1273.74. On the bond side of things, we still have elevated interest rates and yield curve inversion. The 2-year sitting at 4.334%, the 10-year at 3.558. Overall, both bond rates are up slightly on the day, less than 1%. But both are relatively unchanged from where they've been. All of the shorter term issuances than the 10-year are in backwardation with the 10-year, meaning they're priced above the 10-year, which says that the market expects more risk in the short term than the long term, which is a good recession indicator, which is why we talk about it. Overall this week, actually pretty positive for the economy, although only slightly so. The U.S. Services PMI index is a purchasing manager index, which is a measure of hope. It's a sentiment index. Closed exactly where the economists thought it would, at 46.2. slightly over last month of 46.1. So at least we're holding steady there with regards to how purchasing managers across the economy, and those are people that buy stuff for their companies to make stuff, that they're seeing this as relatively okay during the last quarter of the year in which the consumer does most of their shopping. So that's a positive sign. The actual ISM services index itself traded at 56.5. That's above 50, so it's a positive growth number, and it's above expectations of 53.7, and it's above what we saw last month of 54.4. Again, a nice thing to happen. Factory orders are up 0.3% last month, 1% this month, so a gain and above economist expectations of 0.7%. So again, all signs rosy there on the economy. Productivity revision, it was up 0.8% above the economist expectation of 0.7. Unit labor costs, or what it takes basically for labor to produce something, is up 2.4%. It's less than the expected 3.5, which could be positive or negative depending on how you look at it. It does mean less costs, employment costs in the economy, but also means that wages are not keeping up with inflation, which is going to hurt the worker and therefore the consumer. We'll have to see how that trend continues throughout the rest of next year. Consumer credit use, 27 billion, which is a very high number, higher than the 26 billion forecast. And it just means that consumers are using credit to buy stuff. They don't have a lot of free cash. And we're going to watch that number very closely. It's been elevated here the last 4 or 5 months. We're going to see if it continues to be elevated. Is it just prep for the holiday season and all the spending that consumers do in the last quarter of the year? Or will we see that consumer credit levels bleed over in 2023? We'll be watching that. Initial jobless claims came in at 230,000, same as expectation, slightly higher than last month at 225. And continuing jobless claims still elevated, 1.67 million this month. Last month it was 1.61 million. So overall, the economy is doing okay in terms of orders and in terms of purchases, not as well in terms of employment and or wages. So as employment or wages are slightly negative, that will affect overall gross domestic product and sales, and we'll track that as the month goes on. Now we're going to switch gears and get into the metals part of the program. So we'll be sharing you the data from the 𝙂𝙊 group, and we're going to be going over what's happening in the gold futures market. The futures market is where the spot price is determined, and the last trade on COMEX is 1805.80. So more than the actual gold price, which is good. It means we're probably up on the day, about $4 up on the day on light volume. You notice here we have very light volume. So we know it's not going to be a heavy selling day, because usually heavy selling days come when you have heavier volume. That's 99% of the time the pattern. You can have heavy selling days on light volume, but it's very rare. Usually you got to get a bunch of extra paper dumped in on that market to get those prices to move down. February 2023 is now very clearly the dominant contract for gold. It is no longer December. So this is where we'll see most of our deliveries. Of course, we did have 78 deliveries on gold in the December contract, on the strength of 6,500 contracts. Not a lot there. The majority of the trade here you can see is in February. 358,000 contracts yesterday were trading on the market, and overall 2,773 exchange for physicals. I call out the exchange for physicals because that's where you take a contract from COMEX and you go over to London and either demand the physical metal or play price arbitrage with the differences in price, meaning people are going to get either higher prices or the physical from London. And that's just basically what that means. This is Thursday's data. If we drop down to Wednesday's data, these are daily snapshots. You can see that on Wednesday, we had 2,152 contracts of gold delivered on trade of 356,000. Now we're going to go over here to settlements and see where the price is trading at and why. So again, February is a dominant futures contract month for gold, and we settled down as of yesterday's data. This is Thursday, the 8th of December, up $3.50 on the trade overall on all the contracts to close at 1801.50. If you go back and look at Wednesday's data, you'll see that we settled at 1798, up $15 from the day previous on 158,000 contracts. You simply can go here and follow that information, and it tells you exactly what the trade is on the 𝙂𝙊 Group's website, and it will tell you what the spot price will be, because it is in fact that trade that determines the spot price. Now we move over to the London market and we look at the ETFs. The exchange traded products are also called ETPs, if you will. These exchange traded products are ETN and ETFs that store metal. Most of the ones listed here on this chart at Gold Charts R Us are going to be the ETFs. Most of them store the majority of their metal in the UK, although there are exceptions. For example, part of the GLD run by SPDR is stored in New York as well, although it's a minority of the metal. It also has a COMEX number, so we can see a 4-week trend on the COMEX. We've seen about 1.3 million ounces come off of the COMEX overall, out of 1.148, which has come off of the entire complex, which actually means we've had some movement back into the ETF. In terms of gold, if we look at GLT's chart specifically, we've had a nice runoff in gold stocks. We had that in 2013 to 2015, and then it rose twice, and we've had it since 2019 to now. So the trend is to take the metal out of the ETF. So the ETFs have less and less metal. And overall, over the last 4 weeks, you've seen over 1 million ounces go into the market from either the COMEX or the London markets. Moving over to silver futures, we're here. We see relatively light volume as well. This market is much like gold right now, not a lot of selling pressure. And if we look at the trades, the dominant month for silver is March. It's not February. It's different than gold. That means most of the trades will come on that contract. You can see here only 1,800 contracts left in December, and about roughly the same in January, which is not a heavy trading month. Only 19 deliveries as of Thursday's data. If we look back to Wednesday, we had 31 deliveries. Look back to Tuesday, we had 139. So silver is a more lightly delivered market right now than gold is. People are more interested in taking gold deliveries. There are 107,000 contracts traded yesterday on that March contract. If we go over to the settlement data, we can look and see what's happening. This is Thursday's data of settlements, where we see the prices they actually settled at on the March contract. We can see there was a healthy 45,453 volume of closed contracts. They settled an average of $23.25, and that was up 32 cents on the day. A nice positive day for silver. On Wednesday, another positive day for silver, up about 59 cents. On trade of 52,476 contracts to settle at 22,922. We go back to Tuesday, it was down 68 cents, selling at 22.25 on volume of 50,269 contracts. Again, silver's basically moving sideways. Nothing big going on in silver. On the derivative markets, what about physical? Let's look at physical. Well, in COMEX, you've had a net influx into COMEX of silver over the last 4 weeks of about 300,000 ounces. That's not what we expected to see, but nonetheless, that's what's happened, and that's because of recent flows. Some silver starting to come back into the COMEX. Overall, we've had a net increase the last 4 weeks of 5.5 million ounces of silver when you consider the flows are also into the ETF. So silver starting to come back in. You saw a little bit of an uptick right there with silver coming back into SLV. This is SLV, silver ounces held, although the trend is decidedly negative dating back to silver squeeze. It's interesting to note some's coming back in the market. Why is that? Well, prices are elevated. You're sitting here trading $23 silver, so anybody who might have bought it for less than that wants to reap a little bit of profit is going to put some silver back in the market, although that movement is much smaller than the movement out. So I'm not calling a reversal. It's nowhere near a reversal. It's just some silver coming into the market at higher prices, and it kind of gives us an idea of how much silver may come back into the market at higher prices. We're sitting at $4 higher silver than we were not too long ago, and you see an additional 5.5 million ounces come in. Now, that's nothing next to what the supply deficit is for the year. The Silver Institute has revised that in their interim report here in November, that we're going to be 195 million ounces short in 2022. So this 5 million ounces coming back in is a drop in the bucket. I still think we're going to have shortages, but at least some people are releasing some silver at higher prices, and this gives us an idea for what the overall liquidity is. When in a month, silver price moves up $3 to $4, we get an extra 5 million ounces. That'll be a good litmus test or an A/B test to see what will happen when silver hits 25, 28, 30. How much of that silver is going to be free at those prices come back into the market? That's what silver investors want to know. The more that comes back in the market, the more supply there's going to be, the less overall upward price pressure there's going to be. So this is good to see what could happen to the silver market as the price continues to rise. Now we're going to look at the commitment of traders reports for silver and for gold. Nothing too much going on here. This is data as of November 29th. Remember, this report lags behind by about 10 days. So the next couple of days, we should get the next one. Nothing major happening here. We see the swap dealers went more short. So the swap dealers in silver are taking almost an even position. They're at 40,122 contracts long. That's net long, about 3,000 contracts, because they're also short about 37,174 for a spread of about 3,000. Overall, they're about even. So this could mean that silver price is about even or only moves up slightly from here. We've had a nice pop to 23. Apparently, the bullion banks say that's good enough for now. It may drift down to the $21, $22 range or just stay even. But that's what I see the swap dealers basically taking bets as to they think that this is a nice little resting spot for silver right now at $23. And we're going to see if they're right, whether that goes long or just kind of sits here for a little while. The managed money is decidedly long. They were short until very recently. I think they're watching my videos because I keep telling them they're the dumb money when it comes to precious metals because, well, they are. They almost always lose money on the trades. They're smart with other things, not the metals. And I tell them that if you go short, you're going to be basically the dupe to the swap dealers going long. And so they listened, and now they're long 36,960 contracts. The other reporters are also long. So I think a lot of the financial and the smart money on the market is aligning long silver, and it's just producer merchants going short, most of them to hedge their downside silver price risk. So they're going to stay there. So this looks like a regular market to me. It looks like people are going long based upon silver shortage information where they should be, and the merchants are staying short in the producers because they get to hedge their downside price risk. This to me looks like a normal commitment of traders report, much different than what we've had in silver for the last 10 years, where there was rampant short positioning by 4 to 8 swap dealers. That's no longer the case, and it seems like all the smart money's lining up to take silver long, and it looks like a healthy silver market, a healthy setup for a long silver move in 2023. This is what I see. Now moving over to gold and the commitment of traders report, and gold, they're still net short almost by half or almost double, 181,577 short positions, only 98,970 long positions, although you see here they did drop almost 5,000 shorts and add almost 2,000 longs. That's been the trend. So slowly but surely, the shark money, the sharks of the market are moving long in gold, although they're not there yet, which tells me the move in gold's not going to come yet. You still got almost twice as much, maybe 90% of additional downside pressure from the swap dealers. So I don't see gold popping right now. I think silver has much more upside potential right now, but I think gold is moving that direction. And that tells me sometime in 2023 or 2024, the bullion banks are going to go long gold. And that's probably where you're going to get your big historic move in the gold and silver markets. Could start as early this year. We'll continue to watch the technical positioning on the on the market through the CFTC commitment traders report and let you know what's going on. The managed money is now net long gold, so they're expecting to go long. The other reportables, which are the family offices and the smart, wealthy individuals, are long by a factor of almost 5 to 1 on gold. And of course, the producer merchants are short because they're hedging downward price risk, which they have to because they deal in the middle every day. All of that makes sense. So what is my overall impression? Overall, the economy had a middle of the road week. You had some persistent joblessness. You had some persistency downward in the real estate markets, but overall in the production area and the purchasing managers, what they're seeing is a slight uptick. I attribute that to the fourth quarter uptick that you get when you have all the Black Friday sales and all the consumer sales coming in. It's basically where a lot of people go black for the year, hence called Black Friday, the retailers, because they make a lot of their sales at this time of year. Maybe, additional 25, 50% over what they see, sometimes double, and it brings them into the black. And you're starting to see that in the numbers. You're seeing a little bit of an uptick, although not quite what I would have expected. It's very modest. So we're going to track that over the next couple of months to see how well we did the last quarter of the year. It's possible we could salvage this year with a positive GDP and just positive messages overall if we have a strong fourth quarter and the consumer comes in. If we don't, that could be an indication that 2023 could be a lot bumpier. Certainly, a lot of the banks have come out, Bank of America, Goldman Sachs, and some others predicting that 2023 would be very rocky, and we'll have to see what happens there. That could be very prescient calls, but they're doing that based on what they see in the fundamentals. However, for right now, the economic data looks okay. The gold and silver has had a nice pop on weaknesses in the crypto market and weaknesses in the broader market, and on expectations of further Fed rate hikes, although what the Fed announces next year will be key to what happens to gold and silver, and we will follow that. Of course, all of that is in our weekly reports, which we do for the whole purpose of letting you know what was the major things happened last week, what are the things we think are going to happen this week, where all the data is, and so you're prepared for your trading week, listening to this for 15 to 20 short minutes every week, and that's why we have it there for you, all compressed into a quick, easy report. As a reminder, we also do this on podcasts, so you can get us on Anchor, Google, Apple, or wherever you find podcasts. We just found out that Gold Silver Pros in a few short months has ascended to the top 5% of most recommended podcasts and most listened to podcasts on Spotify. And we thank you for that. You, the listener, have been a big part of our success there, and we do appreciate that. This will be on that, by the way. All the content we put out in video form, we also put in audio form on the podcast. In case you don't have time to listen, you can get us over there on your way to work or on your favorite podcast streaming application. Thank you so much for tuning in. Hope you guys have a blessed weekend. We'll be back more next week with more content, as we always are. This is Rob Kientz reporting for Gold Silver Pros. And for JM Bullion, if you're staying on the Gold Silver Pros channel, stay tuned for the weekly metals report coming up next.
This meeting
Hey
is
everyone,
being-
we are back with the weekly metals wrap up. We try to do this every week when our good friend Ian can join us. Ian Everard of Ark Silver is here to join us to talk about the metals markets, what he sees going on. And I think he's got some pretty interesting news regarding silver. And before we get started, we're going to talk about that silver. I'm going to throw one up here. This is a Royal Mint 10-ounce bar, which I think is absolutely gorgeous. This is one I got from Ian last time he was driving through my area. Gorgeous bar. Ian has these. What are you selling these for, Ian, at the moment?
Let me check. We've done an offer today. We're dropping our premium to $7 an ounce. The competition that have got them in stock are charging $11.12 an ounce premium. So
okay, so on the bars, you're beating people by $4.
So that's $40 a bar less. Yeah,
it's quite a bit. And then you also gave me some of these just fun coins. They're basically David Bowie coins. Let's see if we can get the camera to focus. It's got the Queen on one side, David Bowie on the other. Just little rounds. Yeah. Do you have rounds for sale, Ian?
We do. We have a few of these left. They're great because it's the last year the Queen is going to be on a coin, and you have an iconic. I think we have the Who and David Bowie left in those, and they're encapsulated at the mint, so they're potentially in a high grade, sealed up, nice and shiny.
Limited edition. You're not going to see millions of them. It's just
nope.
They coin some and they move on, right?
Yeah, that's it. Yeah.
All right. So those couple of the specials, yeah, we'll get back to specials later. Tell us what's going on, in the silver market. What's going on with bullion? Is it? I know a couple of months ago we were talking about how tight it was, and things seem to ease up a little bit. There seems to be some supply there, although I'm seeing supply come off the LBMA COMEX, and it's funny. There was a presentation by the LBMA interviewing the researchers from the Silver Institute, really Metals Focus, that puts that report together, interim silver report. And on this report, they were talking about shortages. They're rescoping their 2022 shortages. They think, Ian, now they're going to be 200 million ounces short of silver produced by the miners versus what is demanded. So that's why people are pulling off the stockpiles. So given that, I would assume there's still some shortages, but what are you seeing on your end?
Yeah, wholesale premiums have come down substantially and rapidly. So that would suggest surplus stock, but it's a bit more complicated than that. I don't think the correlation is always that clear. I was talking to a major wholesaler yesterday, and they're under financial pressure from their accountants to reduce inventory for year end. So how do they do that? They lower premiums to encourage the companies like mine and bigger companies to stock up, because with a dramatic drop in premium. So that's a big causal effect. I've never looked at it that way, because as a stacker personally, I just want to keep increasing my ounces. I am not going to get caught without my ounces up when this finally pops.
We were talking a couple of months ago about how the premiums are blowing out because of the demand. And it was interesting, Ian. I was watching this LBMA presentation where they're going over Silver Institute's data, and they were talking about premium. And basically, they said you have high premium on retail because retail's demanding it so much. But that's a separate market from what they call professional traders. And what they admit in this video, and people will see this Thursday night on our channel, I'm doing an entire presentation on this where I talk about the LBMA just admitted that the derivatives market sets the spot price and has zippo to do with physical. And that's in a professional presentation done by the LBMA, the Silver Institute, and a couple other people that got together to do this. Now we have industry insiders basically telling us how the market works, confirming everything that people said was conspiracy theory before. It's definitely not conspiracy theory. What's your view on that? I mean, LBMA coming out basically saying, yeah, spot price is not determined by physical. Well, what's your takeaway there as a physical precious metals dealer, Ian? What's your thought on that?
Well, as a personal stacker, it just is so obvious. If we keep buying it, and just going back to that figure you said, 200 million ounces deficit, I wouldn't be surprised if your viewers, Rob, have got
We probably have 200 million ounces together.
It's like, I mean, I don't know what size of the North American stackers market, but the longer I'm in business, we're coming into our 3rd year soon. You know, I'm selling to people who've been stacking, one of them for 66 years. Yes, it does become addictive, but when you're fundamentally persuaded of the mathematics, you know that if it's been manipulated artificially, that can only happen using derivatives, the bets. Well, derivatives, the very word means it derives value from, so it has to be based on physical. So when the COMEX is empty, and it will be emptied, then the derivatives fail. I mean, anybody who has silver determines the price of silver.
It's exactly right. And I want to put something up on screen here in a second to talk about that. Essentially, what we're saying, Ian, is we're looking at Xi's pyramid, and we're saying eventually everything's going to roll back down to gold and silver. And you can see this is a version of Xi's pyramid that I've been basically using in articles. You get gold and silver on the bottom. Then you get into base money, that's physically printed money. Then you get into bank money, which is electronic money. Then you get into the government bonds. Then you got stocks and real estate and things like that, and derivatives. On top here is the ticking time bomb. It seems like the derivatives, if that thing collapses, I mean, it's almost like a reverse taking down of a building. It's like the whole thing's just going to implode all the way down. And all that value is going to end up in the hands of gold and silver will be repriced and to some another level. Is that the way you see this playing out?
Absolutely. And I mean, not just gold and silver. I mean, included in that is any primary wealth, whether it's land, forestry, water rights, real stuff that you can hold. That's where that all migrates into. But obviously the beauty of the precious metals is they're a whole lot more private and a whole lot more portable than a 10-acre field or or a 2-acre forest or wood, whatever that would be. So their privacy and their portability and their fungibility and I mean, they don't go off, they don't go moldy, you don't need to feed them, you know. It's like, so those gold and silver and the other precious metals are the ultimate primary wealth. That's why they've worked throughout history, going back 6,000 years to now. Typically, historically, things have been valued in silver. How many soldiers you could hire in an army was so much silver per 100 soldiers, or whatever, you know. So throughout history, it's always been a measure. It always will be.
Yeah, and I will also add in, whenever they do currency resets, they've always used gold in the past. And with gold being defined by Basel III as a high quality liquid asset in the system, it seems to me as they're going to do that all over again. So you should see gold pop there whenever this system comes under pressure. They're going to go back to what has no counterparty risk. And it's these two things. It's the gold version of this and it's the silver version of this.
Yeah.
And that's what the central banks and the wealthy are stockpiling. You can see it from the exchange data. You can see it in the commitment of traders report. And I think you can see it in the retail end of the market. So what other deals may you have for us today, Ian? Anything else that
you just before we get onto that, I just think it's important to mention, Ron, you must have noticed it, how SLV and GLD physicals draining out of them. So the authorized participants, you can take huge tranches, are taking physical. That doesn't normally make sense. And unless they're getting inside information that we're going to get that reset.
And here's part of what could be happening. If we go back to that LBMA video again, Thursday night, it's on our channel. I break down, the whole video. They admitted that essentially the ETPs, which are exchange traded products, that's where you get your ETF funds and your exchange traded notes, which is basically like a type of paper, commercial paper. But that part of the market is supplying the silver for industry, and that was an admission by the LBMA. Whatever silver is coming off the London market, which is where most of the ETFs and ETPs store their gold and silver, they say it's feeding industry. They know it's feeding industry. So the market analysts there know what's happening. Yeah, it's a shortage. And again, this video just confirmed everything I've been saying for the last year, dating back silver squeeze, I said people are going to take the physical for industrial uses. We got a video saying from the LBMA saying that's exactly, and from Silver Institute Metals Focus saying that's exactly what's happening. And so now you're starting to see that run on the big stockpiles of silver. So I think we are getting closer to that end game. And it's nice, it's nice to get a confirmation from an industry group that says the same thing we do. So it's not just a YouTuber like me saying it. Yeah, I'm a former auditor. Yeah, I can look at the data. But when you have insiders who basically analyze those markets for a living, say that's what's going on, then that's the only conclusion we can come to, I think.
Yeah, I mean, that ties back in, doesn't it, with Andrew Maguire stating just over a year ago that the major refiners were buying back 1,000-ounce bars and reselling them.
And you pointed this out at, I believe it was Silver Symposium last year in Coeur d'Alene, did you not?
Yeah, yeah. And then it ties in sort of, I think about 3 months ago, a major European refiner, I was speaking to one of their presidents, and they were saying they are using silver, they take off the COMEX. So
that's
they're
right.
standing for delivery, taking 5,000-ounce tranches, shipping it to Europe, turning it into product. I mean, like these Germania bars probably came from silver off the COMEX because that was less expensive than buying it from the refiners, because it looks like the refiners haven't got enough to feed the industry, which would suggest that the refiners haven't got enough mine supply. And that ties back in again. Over a year ago, we heard that China was buying up concentrate and doré bars direct from mines. So that doesn't even get counted in the mine output. So there's
one other thing I wanted to say, and why conventional analysis on this market does not work and why we do it different, is because you would assume that the speculators in the market will be the managed money on the COT report, commitment traders report, and in the LBMA webinar, which I keep referring to on purpose. It's important, the bombshells that you find in here when you listen to industry insiders and what they're telling you is going on. Essentially, the managed money they are saying is a speculative investment in gold, silver. But the thing you got to know about the managed money, and if you don't understand this, you'll get fooled. They don't do physical delivery, Ian. So the managed money's not in this for the physical. They're just trading paper. And the fact is that anybody on this market, I don't care where you fall on the classification scheme as a trader, whether you're producing it, you're a merchant using it like Apple, or you're a bullion bank trading positions, financially for a bunch of clients, or, whether you're the managed money hedge funds, any one of them can be speculative. Any one of them can stand for delivery. And I think what we're seeing in the market, Ian, is everybody go for delivery. So you can't just look at, the fact that managed money, took this position, or the bullion banks took this position. Right now, it's a gigantic scramble for anything on the market. And that's what people have to understand when it comes to silver. This is not a normal to functioning market. And the people that are analyzing it make that mistake. They make that mistake and say, oh, it always has to be the managed money doing this. It always has to be the producers doing this. No, everybody's scrambling. Manufacturers are scrambling for supply. Everybody's scrambling. And when you have that happen, the biggest thing to look at is how much inventory is coming off, and stop worrying about the derivative trade. The derivative trade right now has nothing to do with anything. It's people protecting their paper positions in silver. But what you got to look at is the physical trade, and everybody's going for it. Everybody's standing for delivery. And this is different in this market when you have everybody saying, I can use that silver.
Yeah, absolutely. Yeah.
All right. So what other specials do you have for us, Ian, to wrap up the show? I know we talked about the 10-ounce bar.
Sure.
We had the round that I liked that had David Bowie on it. What else you got?
We have 2022 maples.
Oh, beautiful.
Pure, at a $5 premium.
That's my favorite sovereign coin, by the way, Ian.
Oh, okay. I'll send you some for Christmas then. So yeah, though we're selling those at a lower premium than a lot of sites are selling Buffalo rounds for. So we've got the Becoming Rare 2022 Britannia. Let's get it the right way up. We've got those at a $7 premium. We got 2022 Austrian Philharmonics with the shiny edge. We've got those at
those are $6. Gorgeous. They're almost proof coins, Ian. None of those have been circulated yet, have they?
Yeah, they all come in. If you buy a tube, they come sealed with the logo and tape on them. Then we have the Great for Christmas, if you can hold it the right way up, the 2022 Armenian Noah's Arks. So we have those at $5.50. Again, similar price to a lot of people are selling rounds, just generic rounds for. Then, now technically this is a generic round, but I think these are classy. Take your silverback precious metals 2022. It was a British sculptor actually did the artwork from there, so the detail is incredibly fine.
Who's minting those? Is Jim doing it, or does he have somebody doing it for him?
Jim gets, yeah, they get these made by the Kinesis Mint in Turkey. And what else we got? We got some lovely little 5-ounce Germania bars, and they come in their own little box, and they even have, oh, drop it on my laptop. They have a hologram on the back as well. They come shrink wrapped. So that's the 5-ounce. We have some half-kilo ones, just scaled up. They come with a box. We have the silverback 10-ounce bar that Jim Forsyth makes personally in Maryland. So these come literally from ground up Comex bars. Oh, it doesn't end, Rob, really. You name it, we've pretty well got it. We've got some 100 gram.
When you said, Ian, that you were stocked up, you meant you were stocked up.
Yeah, we have the largest, I think proportionally, we've got about 10 times more inventory than all of the larger companies, because my position is the opposite. A lot of companies want to keep their inventory low, so they keep their dollars turning over. And that's nice, but this shiny stuff is going to do a moonshot. I want to have as many ounces as possible. There'll come a time when I ring the wholesaler up, and we had one day where they said, no, we're shut till the dust settles. We're not selling you anything. I mean, we're going to get weeks or months when I'm going to call the wholesaler and they say, well, we're not selling you anything because it's going up $2 a day, $3 a day. We don't know how we don't know where this is going to stop. So yeah, it's Christmas time. I mean, if you don't know what to buy somebody, 5th ounce Citizen CS Live 3 rounds, beautifully made.
I have quite a few of those, yeah. And if people want to order, I'm going to show them how to do it. You basically just go to our website here, goldsilverpros.com, and you click on precious metals, and you click on this link here for Ark Silver, which will take you to the form. You fill out the form, Ian gets it. He'll ring you back. He'll basically email or text you back. So make sure you whitelist this information so that you'll get his email, and make note of his phone number. So if he ends up texting you, you can answer back. And Ian, what has been your best seller recently? Give us something that people have really been interested in.
Oh, that's hard to say. The Britannias seem to be always popular because it's a beautiful coin. People are buying them by the box, because if you have a mint sealed box of them, I think potentially in the future, they got a fair way to run numismatically. The last year of Queen Elizabeth II, although the 2023 has got the Queen on, it's not quite the same, although it'll be interesting to have a set. So, but yeah, the Britannias, the Maples, Philharmonics, the Armenian Arks are always popular. They do sell out. They have a lower mintage than the other sovereign coins. They have a maximum limit of 8 million a year. And so people collect the dates on those. Yeah, pretty well.
Do you basically, you're saying you got a wide range of products, a lot of silver, a little bit of gold in there too, if people want it, Ian?
Yeah, we've got some Pamp Suisse 5-gram gold bars. We've got ready access to all of the major gold coins. Gold Eagles are, the premiums have dropped nearly $100 on those, so they're becoming affordable again.
Well, I will say my experience with Ark Silver has been great. We did the drop ship 1,000-ounce silver bar, which is on your website if anybody wants to see the unboxing of that. We've done tons of exchanges. I exchanged you some gold for silver and got a bunch of these bars, got some of the Kinesis rounds, some maple leaves. But every transaction has just been really smooth. So appreciate you offering good service, Ian. The reason we bring you on is because we know you have that personal touch. People have to reach out to you. You work with every single person that comes through the business to find out what they need. Whether they have a few dollars or they have a lot of money, you're open to all that. So we appreciate you, Ian. We'll have you on the show again next time. Thanks for dropping by.
Thank you, Rob. Take care.